Don Gogel is here with me now. He's the CEO of New York buyout firm Clayton, Dubilier Rice. He's going to tell us the outlook from your vantage point as to how your industry, how your business could be impacted by the so-called Volcker rule. We had Steve Schwartzman on Bloomberg talking about the fear, perhaps, that credit might actually get tighter.
It's possible. I'm not sure that the Volcker rule is going to dramatically affect private equity. The wisdom of that rule notwithstanding, private equity is driven by a number of forces that I think are likely to be sustained over the course of the next couple of years. Private equity is a transitional form of capital, and this is a time when private equity should be showing its stuff and making a difference in sort of fueling some of the global recovery.
So what are you doing? You know, having so much of your industry, your business in the headlines, in the public arena, conversation about it, how do you plan for what seems to be a fair amount of unknown as to what regulation is going to end up looking like?
Well, most likely, from everything that we can tell, most of the private equity is likely to remain unaffected in large part from its core operations. We certainly expect registration requirements. We expect a higher level of transparency. And certainly on the transparency issue, I think a lot of the best private equity firms have already begun to disclose a lot more information, certainly to their investors. And I'm sure the industry will be able to accommodate the kind of sensible regulation that we hope comes out of Washington.
So what does this mean in terms of the changing role in a recovery for private equity?
Well, as I mentioned, private equity is a form of transitional capital, and the emphasis should be on the word private. So firms that have been experienced in this field for a long time, and our firm's been around for 31 years, have the ability to look past what we hope to be short-term cycles. There's no doubt that this is going to be a slow, weak recovery, but finding companies that we think are likely to improve over time, both with the recovery, but more importantly by restructuring some of their operations, introducing best management practices, working on innovation, really elevating the game of the management team. These are things that we think are going to work very well in this period, and hopefully they'll drive employment, growth, and ultimately profitability of these businesses.
How would you characterize the appetite among investors this year, this time, versus last? I mean, what degree of apprehension is there about putting money to work in this space? Well,
I would say a year ago, fear was gripping virtually all investors, and not just in private equity, across all asset classes. And that was reflected, I think, in the dearth of activity that really was dramatically different than the year before. Some of the numbers that I've looked at recently showed that in the year ending September of last year, private equity activity was down 90% from the previous year. But this industry has had
gotten back up to flat there?
Well, I don't think we're going to get back up to that level. It was about $120 billion of activity at the peak through most of 2007, sort of a 12-month period. That was an unusual period of time, and I'm not sure when we'll see that again. But you're beginning to see activity emerge already. We announced 3 deals over the course of 2009, which for us is a lot. You've seen high-yield activity. The financing markets have come back. In a single week, the second week of January, over 11 billion euros of high-yield securities were issued. So the risk appetite, the willingness to step back into an asset class that is a little bit different, that not everyone's taste, but seems to be a remarkable recovery versus where we were a year ago.
Are there any specific industry groups where actually we are going to see more activity in terms of private equity?
You know, the theme, I think, this year is going to be less driven by industry sector activity than selectivity within industries. At its best, private equity is a special situation asset class. You don't buy the whole industry, unlike a public equity mutual fund that might well specialize in energy or consumer stocks. I think you see private equity seeking opportunities in which the public markets either don't value the opportunities or major companies divest assets that they think are no longer core and strategic. CEOs are under pressure in periods like this to streamline portfolios. And I think in those periods, divestiture activity picks up. 80% of our activity over 31 years has been driven by divestiture activity. And periods of disruption create those opportunities for us.
Yesterday on my show, we had the CEO of one of the Bahrain sovereign wealth funds saying that they have a lot of interest in private equity as an alternative to the equity markets. I mean, is that a one-off, or are you seeing different players, sovereign entities themselves, express more interest?
Well, the sovereign wealth funds have been a very important factor over the last 5 years in private equity. I was just on a panel with a gentleman that you were with that interviewed, and he expressed interest in direct investment in private equity, which would mean that he could make those investments directly without going through a buyout firm like Clayton, Dubilier Rice.
Right.
And I think you'll see some of the more sophisticated and larger sovereign wealth funds doing that. But the private equity industry has been around a long time, a lot of sophisticated players. A lot of money's got to be put to work, and 4,000 private equity firms are not going to disappear.